Dick's announced their earnings yesterday, and the stock fell 24% after it missed earnings expectations for the first time in 3 years and cut its profit outlook, citing inventory losses from theft. The CEO said the number of theft incidents and the effect of organized retail crime were far worse than anticipated. Margins were also squeezed by discounting to unload unseasonal merchandise, especially outdoor products such as kayaks and bikes. So this is the daily chart, and not only did Dick's fall 24%, but it was the worst day ever in Dick's history. Let's get into the video before we continue with the analysis coming from Yahoo Finance.
The retailer saw a 23% drop in profit, lowered its guidance due to an increase in theft, which the company's CEO called an increasingly serious issue. Adrian Yee, Barclays consumer discretionary analyst, joins us now. I have a hard time believing that anybody's sneaking tailor-made drivers out of Golf Galaxy, Adrian, but perhaps Dick's knows something that I do not. Take us through your read on this quarter.
So the read on the quarter is that demand is still there, right? They came in at 3.22 billion. The consensus was 3.24 billion. The composition of that, they actually missed the comp. So the comp came in a little bit light, and it was, it was 1.7%, and it was entirely and then some driven by transactions, right? So transaction count, which is great, was up 2.8%. That then implies, right, that average unit retail was actually down. So during the quarter, we love to look at promos, and they were very promotional, which is very similar to what we've been seeing for the past 3 or 4 consecutive quarters. And at the end of the day, they're in an investment cycle. So what do we always say about when sales are going out? It's really hard to be very, very long and aggressively long, sort of companies that are going into an investment cycle, that have been doing well, that are kind of counter to the trend, and that people are already long. The trifecta.
Adrian, it's Julie here. So where are we then in that investment cycle? In other words, when's it going to start paying off in a bigger way?
We're in the earlier stages of it, of a multi-year. So they opened 7 House of Sports, and that is the banner that is sort of the experiential banner. It is the direction of travel of the consumer, right? So kind of getting away from just a place to shop, to a place to experience, search, find, and actually play sports, right, in these House of Sports in some regard. And so that is the right direction of travel. They expect to open over a period of multi-year period, 75 to 100 of these stores. But in the meantime, right, we always talk about early non-comp sales. You don't get the full kind of sales productivity out of that box until they mature over a couple of years. This is the right thing to do. When companies have excess margin and have been doing well, you absolutely want to see them go into investment phase. But it's a painful part of the cycle until you get to the harvest phase.
Adrian, some of the interesting things we've been watching over the past 2 years especially, and some of it driven by the pandemic, is the types of sports that people are playing and the new sports that have come about. I mean, we've seen the game of golf grow. We've seen, and as people are looking to get more into outdoor activities, we've seen games like pickleball just absolutely skyrocket in terms of fanfare. And then you could add on kind of an assorted realm of other sports as well that Dick's would be able to capitalize on. But if that starts to normalize in terms of the growth, what does that mean for Dick's?
I think it's okay because the athletic sporting arena, as you just mentioned, right, during COVID, you had a lot more participants, not only in the adult, millennial, Gen Z, but a lot more participants in the early stages, younger kids entering a more healthy lifestyle. This is a generational trend. So the secular growth of sporting goods, athletics, that is definitely stronger post-COVID than it was pre-COVID. I would also say that even if that normalizes, right, during the kind of period, unfortunately, of COVID, Dick's is one of the, if not the only last standing national sporting goods retailers. Everybody else is sort of regional, and there are a lot of mom and pops and independents that did not make it through this period. So to the extent that they are sort of the 800-pound gorilla in this space and the best execution, right, of this kind of sporting goods play in a secular growth, that's all good for the long term. It just, in this kind of like margin, kind of profit reset, right? You got to take a little bit off of these peak margins that they benefited from in this cycle, take it a step back, normalize it, and then rebase, and then grow from there.
Adrian, How it seems to me opening these new concepts is going to require some more experienced staff as well. And just on a personal anecdotal basis, when I go into a Dick's, there are not enough people in that store. And I wonder how they're doing. You mentioned there's not another national chain that's really comparable, but I do think of the likes of an REI. Yes, it leans more outdoors. But if I go into an REI, I know I'm going to be able to talk to somebody who knows the product very well. I don't have that same assurance from a Dick's. Is there a market share situation happening there at all, or do you think of REI sort of in a different category?
So, Julie, what I would say there is, if you think about a pyramid structure, right, and you think about kind of broad and shallow, sort of, which would be more, and a lot of expertise, a lot of customer handholding, right? That's really on the REI side of things. And then as you kind of widen out that base, right, kind of the volume drivers, right, sort of more to the masses, that's what I think of more sort of as Dick's Sporting Goods. And so I think they play in different parts of the competitive structure. Bear in mind, REI is also a private company, so we can't see exactly what's going on there. But I too agree with you. When you want that expertise and you want to buy that perfect pair of hiking boots for that, Mount Everest climb, you're going to the professionals, right? And that's sort of REI. And so I think of it a little bit kind of as two different market segments. REI plays in a smaller segment, Dick's in the bigger segment and more mass oriented. Doesn't necessarily mean there's not overlap, but I do agree with you about the kind of the customer experience. It's a big store. There's a lot of things in there. And I think you're right that, there could be a little bit more investment in payroll over time.
Adrian, you've got a lot of people who are watching right now, taking a look at these charts, seeing Dick's Sporting Goods shares now in negative territory for year to date because of today's move here. When you think about whether or not investors who are thinking about whether or not they should be buying this Dick's dip in this stock right now, what word of advice would you give them?
I would say just take a pause. Their inventory is clean, so their inventory is very clean. Sometimes clean inventory prevents acceleration of sales because there's not as much to sell in terms of units. We upgraded the sector about a couple of weeks ago, and our upgrade was placed on the beta trade, the ones who are sitting on the low margin.
All right, so this is the monthly chart on Dick's. We can see that we do have a double top. We could also see that we have some wicks down at the, say, $90 to $100 level, signaling buying pressure. This was the pandemic lows, and it almost came down to what served as resistance from starting in 2013. All right, so let's drill down to the weekly chart. Now, on the weekly chart, you can see also this double bottom, but you see a double top. On the monthly, you see a double top on the weekly. So what I like to do is and this is hindsight, but once I see a break of the trend line, I like to see a retest of that trend line. For me, that's an indication that prices are going to go lower. You also have this big M pattern on the weekly chart. So all signs pointing to a reversal, right? So question is, how far can we go down? Typically you get a 3-day rule after earnings. Price continued to decline. However, second day you had a gap down, but it looks like buyers have stepped in. Third day is going to be key in terms of how price opens and closes. You have this gap on earnings, and this is why probably price is reacting. However, I like the $100 level, which is within this monthly band that we noticed. So I'm looking for DIX to continue to fall over the coming couple of weeks, with a buy opportunity between 90 and 100. Thanks for watching. Subscribe. Please like the video.